I was 30 years old and I sat down on a Sunday for 4 hours and I said, okay, I've been talking about wanting financial freedom for so long, but there's a big difference between wanting something and being committed to it. And so I sat down and I pulled up a spreadsheet and I mapped it all out. And it's a very simple equation. I call it the financial freedom equation.
Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show, and this is Dina Berg. Today, our guest is Dave Allred. I know you're going to enjoy today's show as we hear about how Dave went from growing up in a destitute family, starting his door-to-door sales career at age 17, and launching that company into a multi-billion-dollar company. After going public, he led to 121 sales teams across 41 states, and at age 30, committed to building a portfolio of 1,000 rental doors by age 40. He achieved this goal and then launched what now is his current employment, Axia Partners. I love this discussion with Dave. He talks a lot about work-life balance. He tells us how he incorporates his children into investing, into generosity. Love the balance and the velocity that Dave's life is moving at, all yet with a steady sense of peace in the midst of it. Let's jump into the show. Dave Allred, it is a pleasure to have you on the show today. Thank you so much for joining us.
Grateful to be here. Thank you for the opportunity.
Good. Well, let's jump right in. And I would love for you to just start by give us a brief flyover of what was your journey to financial freedom. And then let's spend the majority of our time talking about what you're doing now and some of the things that you're passionate about. Sound good?
Sounds great. Brief flyover. So from Utah, grew up in a very, low income, poor home. Never talked about business, finances, real estate, investing. I was going to college. I got recruited to go out and sell home security systems door to door. So I didn't want to do it. I knew it was going to be really hard. In fact, I don't think anybody really wants to go and do that, right? It's probably one of the hardest ways to make a dollar. But next thing you know, I'm out in Chicago, Illinois, knocking doors. And it was by far the hardest thing I've ever done in my life. Most of my team quit. 80% of the guys, left. And anyway, I made it through that summer.
Well, hold on. What made it so hard? I'm really curious about this as an inception to where you're at now. What do you think were the main challenges? Just the ongoing rejection or getting through to the pitch?
Just the relentless failure, just nonstop getting your teeth kicked in, just failure. I mean, literally it's, 99 no's for everyone. Yes. And so, and I was in Chicago. It was a lot, out of my element. Knocking doors in the first place is just kind of an awkward process. And you mix into the fact that, you don't have a boss looking over your shoulder, and it's really all about self-discipline and really it's about, grit and mindset and being able to really just mastering your own emotions. And I'm actually really grateful for it because it's taught me a lot about mental fortitude and how to continue. Actually, what it taught me is how to be comfortable being uncomfortable, which I actually think is a very valuable skill set, both in business and even as a father, as a husband, being willing to be uncomfortable in that pursuit of delayed gratification for what you really want is a very, very valuable skill set. And so, it turned into that 4-month season turned into a 17-year leadership career, managing 121 sales teams across 41 states. And I learned so much from it. It was really an incredible way to be able to make active income, to be able to aggressively put that into passive income real estate. And, that first summer, I made $31,000, which for me at that point in my life was incredible. It was more than my parents had ever made. It was incredible. I was incredibly grateful for that. And even to this day, I would say that was the most important money I've ever made in my life because it allowed me to come back the next year as a sales manager and make $156,000, which was the second most important money I've ever made in my life because that really broke through all those limiting belief systems that I had as a kid. If you'd asked me when I was a child or even as a young man, best case scenario, if I played my cards right, I might be able to make $100,000 in a year. And that was like best case, if everything worked out perfectly. And so, making 156,000 really kind of opened my paradigm, and it really created this, this shift for me. Came back the next year and made over $250,000, the next year over $500,000, and just this really incredible journey. And not so much as knocking doors, but more of a leadership career. And I also just want to say real quick, even my children now, I've got 4 children, and they are all expected to go do at least one season of door-to-door sales, because I really do. I know, and they're not stoked about it, for the record, but I think it teaches so many good soft skills that can go out and help people win in life and in business. And even in real estate now, I run a real estate fund called Axia Partners, and we have 300-400 investment partners right now. And a lot of those same skill sets, they play into real estate, right? With negotiating, with salesmanship, with managing relationships, with communication, interpersonal development, leadership, all those things that we learned from doing those hard things earlier in life.
And I love what you said about the importance and the power of being uncomfortable. I feel like we can all identify with that. I mean, I can identify with that. And in your spirit, you just want to get out of it. You just want that, like, you can call it anxiety or uncomfortable, place to be over. But what you're saying, and I totally agree with you, is that's kind of, in a sense, what's catapulting you or launching you or pushing you forward into what's next, higher levels.
And I'd even add on to it further that kind of my approach in life has been, if something scares you, it usually means you should do it. And, and that way we're not scared of it anymore. And it really is empowering, and it helps us become the best version of ourselves, because we know we can do hard things. And I'd even take it into real estate, where, a lot of the deals that have been the best deals and the most profitable deals are actually the ones that they have some hair on the deal, right? They're a little scary. And so most people don't want to do it because it's going to be hard. And even in our fund today, we're a heavy value add fund. And so a lot of our very best assets have been ones where it's a little hard, it's a little scary almost jumping into it. So I think that's a good principle for life in general.
Man. Okay. Let's jump right in then to your transition from working all the way from the door-to-door salesman position up until where you leapt off into syndication, fast forwarding even now to the fund. Talk a little bit about those transition points and kind of leaning into what you're doing now.
So after that first year as a sales manager, making, 156,000, I went to my CPA and I said, hey, what are all of your wealthy clients? Because I thought I was wealthy, right? Like, what are your wealthy clients doing to help mitigate, tax liability and to, be intelligent investors? And he said all of his clients were either buying real estate or investing in businesses. And so, hey, this real estate, that sounds cool. That sounds fun. I'm gonna become a student of the game of real estate. And I just took it upon myself to begin to learn and get mentors and proximity to other people that were doing really what I wanted to be doing. And, I realized a long time ago, at my core, what really fires me up and motivates me is freedom. At my core, my primary core motivator is freedom. And it's freedom to be able to be doing what I want to be doing with people I want to be doing it with when I want to be doing it. And so, knocking doors wasn't a fun job in any means, in any capacity. And so it was like, how can I get out of this and be able to create an incredible quality of life for my family, for my children, and for myself with freedom, lifestyle freedom. And before I forget this, I want to make sure I mention this. When I first got so focused on freedom, it was financial freedom, right? Having enough passive recurring income to be able to cover my family's cost of living. Once I achieved that, it actually changed to be more of a focus on time freedom, and that's actually way more important in my opinion than financial freedom. But you have to have financial freedom to be able to create that time freedom. And then more recently, it's actually been more of a shift towards lifestyle freedom. Right. So it's curating the lifestyle that you really want for you, for your family, and those that you care about. And so, I realized early on that real estate was going to be the best way to be able to create that consistent mailbox money, and also for all the tax advantages. And so I was 30 years old, and I sat down on a Sunday for 4 hours. And I said, okay, I've been talking about wanting financial freedom for so long, but there's a big difference between wanting something and being committed to it. And so I sat down and I pulled up a spreadsheet, and I mapped it all out. And it's a very simple equation. I call it the financial freedom equation. So on a spreadsheet, the first line item was, what's my cost of living? And let's, as an example, say it was $200,000. And then the next line item is, what's my current passive income? And that time it was zero, and then the next line item is, how much more passive income do I need? So $200,000. And then the next line is, how many years am I willing to commit to achieving this financial freedom goal? So for me, it was 10 years. And then that gives you, so in that situation, I needed to have, $20,000 of new passive income created per year to be able to achieve true financial freedom by age 40. And so in order to achieve that, I kind of reverse engineered the math. I need to have 40 rental properties. And so the mantra became 40 by 40. So 40 rental properties by age 40. And I made all my passwords 40 by 40, my home screen, my phone was 40 by 40. And I just really internalized that and really started to measure that. And which, by the way, I think it's so powerful to write down those type of goals and to track that. When you write it down, you can see those incremental improvements. And so it's exciting, it's motivating, and also hold yourself accountable. So anyway, hit that goal when I was 36. And that's when I retired.
Dang, you overachieved by 4 years. That's awesome.
I did. Thank you. Appreciate it. It was a really fun journey, and we can even kind of dive into how I did that, specifically. But then hit that goal, celebrated for a day, and then reset the goal as ownership in 1,000 doors by age 40. And that's when I retired from, door sales and went full-time into real estate. Started doing syndications. And
okay, so this 45 by 40 thing was a side hustle while you still had your W-2.
It was.
Oh, I didn't understand that. Okay.
I've actually never had a W-2 job since I was 18 years old. I was an independent contractor, 1099, okay. But close enough.
Okay,
yeah,
gotcha.
So it was a side hustle. It's literally just taking that active income and moving it into passive income real estate along the way.
So 40 doors, single family homes, or like commercial real estate and syndication?
So I actually want to share this because this was such an incredible process for me. And I'm kind of surprised when I share this, how many people don't really understand like the velocity of money. And so the quick story here is my first investment was in 4 townhomes. They were short sales at the auction. So I paid $100,000 per townhome, 4 of those. Fast forward a few years, they're worth twice that. So worth $200,000. So I did 4 1031 exchanges from those 4 townhomes into 4 fourplexes, right? Wow. So 4 doors to 12 doors. Fast forward 3 years, those fourplexes had about an additional $250,000 of equity appreciation in them. So I sold all 4 of those fourplexes and went into 12 new fourplexes, all through 1031 exchanges. And so I kept doing the same thing. I literally went from 4 doors to, I think it was 64 doors with no additional money out of pocket, purely through using that equity appreciation as the down payment through a 1031 exchange, right? So there's no tax liability along the way, or at least defer the tax liability. And so anyways, an incredible way to scale a portfolio without having to infuse a lot of new money into it as we went down that road. And so that was really how I accomplished that first goal.
Did you property manage? How did you handle that on the side?
No, I've actually never managed any property myself ever in the last
that's a relief years. I just gotta say, I'm like, I don't know how people do it anyway, but to hear you say that, I feel like it makes it more doable for listeners and individuals who might want to set this kind of goal. But go ahead.
I really do. I mean, I think ultimately it just comes down to what is your highest and best use of your time, right? And if some people are more operationally focused, and that's where they get energy and passion, awesome. Feel free to do that. But for me, my highest and best use was to continue, being a leader of men and running all these, these offices across the country and earning, a really good active income, and then being able to just transition that over into real estate. I call it stack and rack, right? So you want to. And I think it's actually even more relevant right now today where we are in real estate, because in the last 12 years, we've had such a tailwind behind us where, you could wholesale or flip properties and do more of the transactional real estate. But I think right now it's more important than ever is, if you can just earn a lot of money, through your day job or active income, and then be able to move that into real estate, it's just a way to get started a lot faster in real estate, right? Versus just kind of trying to, what's the right word? Bootleg it, right? Where you're just not really putting a lot of money into it now, and you're just hoping for that appreciation over, with time. So, but yeah, it's been really fun. Honestly, I'm so grateful for having learned about real estate, when I was 22 years old, because it has created so much freedom for me. And I really do believe it's the best way to create, not only time freedom and financial freedom and lifestyle freedom, but really generational wealth, right? So not just for me, but also for my children and hopefully their children as well.
Amazing. I love that. Do you have any kind of outlets to connect with folks who, let's say, are in their 20s or even in their 30s to testify to how powerful real estate was for you?
I knock out about at least one podcast like this, per week with different people that I look up to in the real estate space. One of my own personal goals is to help at least 1,000 people become financially free through real estate, and also to create direct value for at least 10 million people. And so, I love giving back. One of my all-time favorite quotes is from Zig Ziglar, and he says, "You can have everything you want in life if you help enough other people get what they want." I did launch a website, daveallred.com, about a month ago, and it has a lot of my podcasts, blog posts, newsletters. I have a template in there called lifestyle design, which is something I'm really proud of. I've worked on it for 15 years, and it's the 10 areas of my life that I want to be great at, finances, health, family, time, spiritual experiences, relationships, personal growth, etc. And I basically have written down everything that I want to accomplish in those different categories to live a life with purpose and intentionality and with no regrets. And so I've actually added that template to the website, and it's a free download if anybody wants to jump on there and check that out. I even made a youth version of that real quick this summer. Yeah. So I've got these 4 beautiful kids, right? Ages 8, 11, 14, 17. And so, my lifestyle design has given me so much kind of purpose and direction in my own life. And so I kind of watered it down a little bit into a youth version. And so this summer I spent, a few hundred hours with my kids going through that and helping them identify, how they would envision the best version of themselves in each one of those 10 areas. And so that's a downloadable copy as well on my website, which is, free for anybody that wants to. If that feels like they get value from that, feel free to jump on there and it's a free. Anyway, it's trying to create value for people.
I'm definitely going to take advantage of that. I have 3 kids as well, younger. So I don't know if I have a couple hundred hours like you just said you did, but it's probably worth it, right? You think about passive income and generational legacy. It's what we invest now.
I would say, to me, I feel like the best thing I can do as a father is if I can help my children to see the best version of themselves and to internalize that and even have it in writing in those 10 different areas in their life. I mean, that's about the best you can do as a father, as a parent, because when they go off to college and, they go and do their own thing, they're going to make their own decisions. But if I can help them envision what that looks like to create happiness and fulfillment and a life lived with purpose and without regret, I mean, ultimately, I think it's just been a really fun process for me to build that with my family.
For you to even state that, though, as well as, I think about you having 1,000 doors, but helping 1,000 people become financially free it's so significant. So I think both sides of that equation are so powerful as you train your kids, as we train our kids,
Well, speaking of children and helping them, another thing that's been really fun for me is to hire all of my children as my employees of my own, real estate company. And so they're all employees. And, if any of my children walked in right now and I said, "Hey, what's the best type of income?" They would all say passive income. Like we really ingrained that for them. And, they're all very competitive with each other and who's, got the most passive income. And, my daughter's got, she's done a JV joint venture partnership with me on some real estate and, owns a duplex right now. And in fact, she wanted quick story. She wanted a Tesla Model 3 really bad for her birthday, right? Last year. And I'm like, no, there's no way we're going to do that.
Is this your 17-year-old?
Yes.
Okay.
Yeah. And I'm like, no, we're not gonna do that. That's completely irresponsible, right? But after 2 2 weeks of her just continuing to push for it, which, by the way, it's a double-edged sword when you teach your children to be good salespeople, right? Because no means yes all of a
To
sudden.
overcome the no's, the rejection,
Yeah,
100 a day.
yeah, just relentless, right? And so, but I kind of stepped back and I thought about it, and the higher quality question for my daughter would be, all right, so this is a depreciating asset that you want. So how can you create enough passive income to pay for the cost of this luxury depreciating asset? And so so went back to her and said, okay, so it's gonna be $350 a month. So if you want to sell off some of your stock portfolio and some of the cryptocurrency that you bought, when you're 14, it's appreciated a lot, and then move that into a duplex with me. That's going to create $300 of recurring cash flow. And then, you can help mom kind of Uber the kids around with your new vehicle, and I'll pay you, X amount of dollars per hour. So she's now making, $400 a month, relatively passively, still protecting her nest egg in the real estate's appreciating. And now she has the car that she really wanted, right? And so that's really beautiful, because it's teaching, the kids like, hey, you can have whatever you want, but the right way, the mindset is, how can I create the passive income to be able to afford these items? So,
man, that is such a good story. I love that. Keep going. This is so good. So I want to hear about your fund. I mean, we can feel free to talk about lifestyle and family at any juncture, but I want to make sure I hear about how you transition from syndicating into a fund.
Sure. So I did about a dozen syndications, multifamily development. One of them was actually helping bring a Topgolf entertainment facility into Utah as well. That was a really fun one. But I'm really proud of the fact that I can say, out of the 400 plus investors that I have, the investor capital with me, I've never once lost $1 of investor capital in any real estate deal. And, I'm proud of that reputation, and I wanted to make sure I can continue to say that. And so in 2020, I'd been investing into a few different real estate funds, and I really fell in love with the fund model because of the fact that it has a lower risk profile. And specifically because instead of investing in one address as a syndicator, I could invest into multiple different real estate assets into one portfolio. And that effectively mitigates a lot of the downside risk. And so what we do is, so that was one of the big benefits, is risk mitigation. The second big benefit is, the market's been so competitive where a lot of times you go into a bidding war on, say, a multifamily deal, and there's, 10, 20, we had a deal in Atlanta with 62 offers coming in on it.
Oh,
and when we can come in and say, hey, we're a fund, we're already fully capitalized, it gives you a real advantage in a very competitive, negotiating situation. Also, as a syndicator, one of the most stressful parts is you find the deal, go under contract, and then you have to go out and find the capital, right? And you only have maybe a 30 to 90 day window to do so. Whereas in a fund, you're fully capitalized. So it just makes that, that hunting process or that acquisition process a little bit more, not only enjoyable, but more competitive. And then the other thing is, usually in a syndication, I can only bring in, 10 to 25 of my friends. In a fund, I can bring in, up to 999 investors. And so I can create a lot more value for a lot more people through the fund structure. So those are probably the main reasons why I decided to switch from being a full-time syndicator into a full-time fund manager. And so it's been a really fun process. But again, I love syndicating. And some of my investors actually did like knowing what the underlying asset was in a syndication versus in a fund where you're really more investing. You're investing in the investment thesis and more of the jockey versus the horse, right? Mm-hmm. And so, but it's been really a beautiful process. And, to me, one of my goals in life is to always do bigger deals than yesterday. And so whether that was going from townhomes to fourplexes to a 20plex to a, 128 units to 400 unit deals, and then going to syndications, and then going to the fund model, I just found that if you're always doing bigger deals than yesterday, you're going to have that personal development, that forward progression, becoming the best version of yourself, working around other people doing big things. So you have that proximity, which has been really fun for me. And so that's kind of the overall kind of the mindset, I guess, behind the transition into the fund world. And one more thing to share is, when I do a syndication, it was, just multifamily or just, inline development or whatever else, self-storage. With our fund, our whole approach is recession resilient real estate. And so we're able to go out and acquire industrial warehouse, which is projected to be the top performing asset within real estate in the next 5 years. Self-storage, which historically has been the most recession resilient asset. And then multifamily apartments, which is, bread and butter. I love multifamily. And so with our fund, we're able to go out and acquire all three of those asset types. And so an investor comes in and they get a, real pro rata equity position in all three of those different asset types. So not only do we get diversification, but it's also asset diversification as well as geographical diversification across multiple states. And so again, our whole approach is simply, no matter what, we don't want to lose money. And so we really strive to find asymmetrical risk return, meaning that we can mitigate the downside risk of loss, but still create strong yield for our partners. So it's been fun. It's actually been really, really fun. And again, you can probably tell I'm very passionate about real estate. This is something that, it's been awesome. I'm really grateful for having learned about this and being exposed to this, earlier on in life.
Yeah, I can tell that you're having fun. It's coming loud and clear, it's so engaging in conversation. I think it would be really interesting for you to break down some of the details. I think a lot of our listeners are accustomed to how a syndication works, when your distributions might start, how those things work. Can you just kind of break down for us, if you invest in a fund, what that looks like? Do you start accruing interest right when you invest? How much capital is sitting in the fund for you to deploy to have the competitive advantage against the other bidders? And then, like the overall word as you're talking is just, probably about you, Dave, but also your fund. Velocity is what I'm hearing, it's exciting to be around, but would love to hear a little bit more about, like if you talk with an investor, how does it work?
Sure. So I'll preface this by saying there's so many different ways of setting up a fund. And so they're not all the same. And really, it's one of the beautiful things about a fund is that you write the operating agreement, you kind of write the Bible that dictates exactly how the fund runs. And so you really can curate it very much to maybe your own investment thesis or your own, how you personally operate in real estate. And so the way we structured it is it's surprisingly similar to a syndication. For example, we're raising $40 million in equity right now. That will allow us to go out and acquire around $110 million of commercial real estate. So right now, we just take in subscription agreements and that reserves space in the deal. There's actually no transfer of capital immediately. And then the way we've done our capital calls is we do one capital call per quarter. And so we spread those out, and the amount of the capital call is dictated by the size of the deals that we're going to be closing on that quarter. And so, a lot of funds will call in the full 40 million up front, sit on a pile of capital. But to me, sometimes that could lead to being a little irresponsible with your due diligence because you just want to get that money out to pasture. And so for us, we only call in the money that we actually need per quarter to deploy. And also because we're paying an 8% pref rate. And so as soon as that money comes in, then we're on the clock for paying an 8% coupon. And so that's how we raise the capital, how it comes in. And then we made an election.
Anything binding though? Let's say an investor says, I want to be in for this amount. How can you, as the operator, count on those funds being transferred when it comes time?
That's such a good question. And honestly, I was so nervous about that in our first fund. We had 157 investors come in our first fund, and I'm really proud to, and I was assuming maybe there's going to be maybe a 10 to 15% attrition rate there, and I'm so proud to be able to say we actually had zero attrition on that.
That's incredible.
I know. And on our second offering as well, and now we're on our third offering. And I'm actually surprised about this. We've had literally zero attrition throughout the first, 2.5 offerings that we provided here. And not to go on a tangent, but I do want to share this. I think that this might add a lot of value for your listener base. I would give credit to that to two things. One is that all of our investors are, it's really our friends, it's our family, it's our social network. I've never paid for an ad on Facebook or, any advertising. It's all just relationship capital. It's friends, right? And family. And secondly is we do something, I came up with this term 2 years ago, experiential investing. And if you go to our website, axiapartners.com, on the homepage in big font, experiential investing. And what that means is instead of just making sure we get an ROI, return on investment, we're committed to an ROE, a return on experience and education. And so every month, we'll do a full webinar with the top guys in the industry, Joe Fairless, Dan Hanford, Neil Bawa. I mean, we'd love to have Whitney jump on with us. And they just teach and share value for 45 minutes, followed by 30 minutes of Q&A. Also, every time we close on a deal, we do a full webinar with all of our LPs, and we show how we found the deal, our underwriting model, full transparency, how we source the debt, our business model, all of it. And so it's really, it's creating value in a way that's very unique. I'm not aware of any other real estate funds that are so committed to that transparency and a value proposition of education. And what I found is, a lot of people want to be doing these type of big commercial real estate deals. They just don't know how to, they lack the confidence and or the competence to do it on their own. And so if we can actually teach and educate how to do what we do, it's been received very, very well. And so all that focus on value creation, I think, is why we've been able to have, such a sticky investor base.
Yeah. And it goes back to your philosophy that you shared earlier about if I can, add value to other people, it's going to help me to achieve my goals. I completely agree with you. And there's a sincerity and I think people these days have really high BS meters and your sincerity comes through. And I think, if there is genuinely a desire to help move the needle on people's understanding, I mean, it's mutually beneficial because then you're empowering them with information. Then they feel more comfortable entering into the deals, understanding the terms that you're discussing, understanding the opportunities. So it's mutually beneficial, but I think that you're right. You're sincere in that desire, and it's crazy. It's kind of goes back to it goes around, comes around,
100%. Right. And that's really what's been fun for me too, though, is, when you put the LP first, right? So no matter what, the investors come first, then what you end up doing is long-term is you get a lot more repeat investors. And repeat investors for me has really been maybe the kind of the secret sauce, if you will, right? Because it's just so much, it's not only is it easy, but it's actually fun, right? Where you've helped them win and they've had a good experience. There's been good investor communication where the experience leads to repeat investments, and it's more of a plug and play. I mean, I have a few friends where, over a dozen deals together, and it's literally like, okay, what's the next one? Okay, are you doing it? Cool. Your due diligence is all right. I'm in. And so, but going back to the question on the fund structure, so we raise the capital, we deploy it. You go out and buy $110 million of real estate. And what we do is we pay a pref rate, right? So we do 8% preferred return. We decided to give 100% of the tax benefits to our partners. And so we don't take any of the depreciation. So we actually have a lot of investors that come in, even more so for the tax benefits than for the cash flow or for the equity appreciation, which is interesting. But then we also decided to use what's called a European waterfall versus an American waterfall. And if basically what that means is just, again, the investors come first, meaning that on the waterfall, and so waterfall means on a disposition, as we wind down the fund, the prioritization of where the money goes. So first and foremost is the investor gets paid back 100% of their initial investment. Number two highest priority is the 8% preferred return per year. So as an example, say somebody put in $1 million. After a 5-year, fund, that's 40% on the pref rate. So the first 1.4 million would go to that LP first and foremost before the GPs can take any chips off the table. And then whatever that pool of profits is that's left over is then split 80-20, with 80% going to the GPs, 20% to LPs, and 20% to the GPs. And so to me, that just creates like a really strong alignment, right? And I'm not promoting our fund specifically. I'm just sharing this as an example. When I go and invest in funds, I want to make sure there's a really strong alignment of interest where the GPs only win or make money once they've actually done what they say they're going to do, right? Mm-hmm. So that alignment, I think, is very, very important. So we decided to use what's called the European waterfall, which again basically means that the investor has to get paid back first plus pref rates before we can take chips off the table. Even with fees. I mean, there's like the management fee, for example. But like for us, that's actually just pays for our employees, our office space, kind of keeps the lights on. And so it's not a profit center, of course. Gotcha. Okay. Wow. Anything European is better than American, in my opinion. You had me at European. Well, this is great. I would love to. Okay. So let's I have a couple more technical questions, and then we can talk about what your family work-life balance looks like and just the concept of lifestyle design. You talked about you have a lot of value add, and just going back to that, the tension point of being uncomfortable
within that, this is something, that it is the rub of value add, is that there's a lot of equity to be had, but bringing investors along in the bumps in the road during a stabilization process can be an emotionally jarring journey for folks who aren't used to it. I think for operators, it's, all part of the blocking and tackling of a value add. But talk to me a little bit about the hold period and how you engage with your investor base in their experience with the value add and some of the tension that can lie in that kind of a deal.
Yeah. So first off, as an example of the experiential investing commitment. So anytime we go out and we do a site visit, or we even go and look at a potential acquisition, we'll actually invite our LP base to come out with us. We don't pay for their travel, but they're welcome to come out and actually walk it with us, just so they can see how, again, they can, boots on the ground, see how we do what we do.
But how many actually show up? I'm so curious.
Not a lot. I think people appreciate just the opportunity to be is there, but very rarely, because it's usually 2 to 3 days with travel and whatnot as well, getting out there. So but maybe it really depends too on geographically where we're headed to and whatnot. But so not a lot. But again, I think it's just appreciated that it's
I like that.
there. But then also we have a monthly newsletter and quarterly reporting, and we have a lot of the videos or pictures of the site visits. So they can actually kind of feel like they were there. But value add, I think that expression's been, I don't want to say kind of played out, but it's such a common expression inside of especially multifamily over the last probably decade, especially the last 5 years. And so our approach to value add is, yes, it's the traditional, new granite countertops, new paint, kind of lipstick on the pig, if you will, but it's a lot more innovative as well. And we found a lot of success with, again, creating these experiences, not only for our investors, but also for the communities. And so, putting in dog parks, or we call them dog spas. It's kind of the same thing, but, like shared office space, almost like WeWork in the multifamily assets, has been really well received. Search engine optimization. I've been surprised how many of these assets have zero presence on social media. And nowadays, a lot of people do business through social media. And so we always create an actual online presence, not just with rebranding through websites and, rebranding the actual property, but also in social media. And that's been a very unique kind of approach to value add. So it's just more of it's all the older stuff, but it's also a little more of an innovative, updated approach to value add. And when we look at what markets we go into, I think that this is so important right now, especially with where, the economy and the housing market is and is headed. We really love going into, I'd say our number one factor we really look for and we focus on is positive net migration. And so, as Wayne Gretzky says, it's not about where the puck is, it's where the puck's going. And so if we can figure out where people are moving in, there's always going to be that, a higher demand. And so we love Texas. We love Florida. We love Tennessee, Georgia, the Carolinas, Missouri, Utah, Idaho, Arizona, Nevada. So those are probably our top 10 markets right now. One thing that's interesting on that too is, they happen to be all red states, and it's not a political thing. It's just, the idea of eviction moratoriums and rent control and some of that stuff really scares us because we can't control that, right? And that really can have a negative effect on our pro formas and our targeted returns for our investors. And so we really try to stay more in the, landlord friendly states as well.
Makes sense. And you mix the different asset classes within the fund. So you'll have all the different ones that you mentioned in the same fund.
We do.
Nice. I like that.
Which is an interesting value proposition for those that maybe are kind of just getting started in real estate, or they maybe have limited resources where they're not able to go out and put, $250,000 investment into an industrial park, or into fund or a multifamily fund and a self-storage fund, but to be able to get real exposure, direct exposure to all three of those recession resilient asset classes. I think that's why, this investment thesis has been received so well, and just the timing. I mean, I'll just take 1 minute on this, but I'm so excited about where I believe that the real estate market is right now and where it's headed. There's so much fear and uncertainty right now, and there's so many people talking about how scary it is. But to me, I mean, that's where real opportunity is created, right? It's when there is distress, and you can be opportunistic and be aggressive and go take advantage of those opportunities. I think there's actually a really interesting slide that I was just covering two weeks ago, where it shows over the last 2 decades, the most successful real estate funds in the United States were those that were launched during an economic downturn, right? Because you're able to go and get those really incredible basis on those assets. And so anyway, we're very excited about that. I think that, having kind of positioned ourselves as, with a main focus on asymmetrical risk and recession resilient real estate is the timing couldn't be better on it. And I think that's good advice for anybody that's looking to really, either get into real estate or even double down on real estate, is no matter what, make sure you don't lose. Like, when you lose, it literally is 1 step forward, 2 steps backwards. And well, Warren Buffett says it the best. He says, rule number 1 in investing, don't lose your money. Rule number 2, don't forget rule number 1.
Yeah. I mean, nobody wants to come into an investment thinking their capital is at risk, or initial investment. I mean, the reality is none of us can guarantee anything, but if you have enough of a track record to prove the successfully getting through rule number 1 and then rule number 2, I mean, I think it's a great projection for the future. Let's transition and talk a little bit about lifestyle design and family work-life balance. What does that look like for you? And what's your next major threshold? You said there was one at 30, there was one at 40. What's on your screensaver right now?
Hey, that's a great question. I love that. It's currently, I'd like to have Axia partners, up to $1 billion in 2025. So really just growing Axia partners and what we're focused on right now. That's the first thing. And the second thing would be, we launched the Allred Family Foundation, and I want to take a minute on the company. This is really fun for me. And so it's just really giving back and focusing more on impact. And so what I did was, it's really simple. You just set up, it's called a DAF, a donor advised fund, super simple to do. And I have all 4 of my children on my board of directors, and I let them each choose which foundation that they want to support. And so, my oldest, she wants to help single mothers. My other daughter wants to support Operation Underground Railroad to help, with sex trafficking. My son chose the Wounded Warrior Project, and my youngest, she chose to help the local animal shelter. And so, we're able to just go over there, once a quarter or twice a year, and make a little contribution. But it's so fun to have the kids actually participating in it, right? And I feel like children, especially, they learn best through participation. It's not just teaching or talking or even showing. When they have to actually do it, like, it means so much more to them. And so, the way I'm not a CPA, or I can't give tax advice here, but one thing that we do is, I have my children as employees, and you can pay them up to, $12,900 per year in a wage. And that's a tax deduction to the business as a wage. And then they don't have to file, because it's below the minimum threshold to have to file with income taxes. And so it's an interesting tax play there. But then with that income that they make, 10% of that automatically goes to our family foundation. 30% is discretionary, spend on whatever they want to. And then 60% goes towards education or investing. And so that structure allows me to, pay them well, but then they're actually learning about real estate by being an employee and working with their dad and their, in our family business. And then they're also giving back, and they're also kind of forced savings to be investing in real estate and future education. And so that's kind of the structure that we used. But going back to the family foundation, I just really believe that the more you give, the more you live. And, especially when you're in an opportunity where you have the means to be able to give back, I think it always comes back at least twofold. And it's actually, it's kind of funny. I think it's actually almost selfish giving sometimes, because at the end of the day, it makes you feel great, right? So like, you give and you help, and then it makes you feel really good. And so it's actually almost like self-serving sometimes, but it's really creating a win-win situation, right? Where you're adding value for other people. But anyway, as a dad, it's really fun to be able to see, your kids get into it. And, my kids all want to be entrepreneurs, and my son wants to start a vending machine, and my daughter wants to start different businesses. And it's fun to be like, hey, that's awesome, right? So you can go maximize your earnings, you're going to be able to give 10% of all that additional earnings to go help these charities, right? And it's just a different approach to it. So you're not just focusing on the dollars and the cents, and net worth and whatnot, but there's more meaning behind it. And I think that, sorry, I'm kind of going long here, but I think that, when I talked about hitting 40 doors at age 36 and 1,000 at 40 and these different maybe, steps in the success ladder, I think a lot of that's been because I've tied so much purpose to the outcome, right? It's really not about just net worth or even just about how much passive income. It's what do we get from that? It's the freedom, it's the lifestyle, it's traveling the country, it's being able to pay for your children's incredible honeymoons, right? It's being able to help them with higher education. It's being able to, spend time with my wife, to be able to do things that are really important to me. So I think my final advice on that would just be is to spend the time to really get clear on what's important to you and what fires you up and what gets you passionate and really living life fully. And if you can pinpoint that and get that really clear and then just reverse engineer, what you need to be investing in, what type of real estate, what kind of passive income, just get really clear on that. Make a blueprint of exactly what you need to do to be able to achieve the life of your dreams. At least for me, that's been really powerful. And it sounds simple, right? But most people just don't spend the time to actually sit down and think what they really want in life. It's kind of crazy. I often say most Americans spend more time thinking about their annual vacation than they do planning out their life.
Totally agree. Do you guys do like an annual retreat, you and your wife or you and your family?
Not anything formal. I think that's a great idea, but we haven't done that yet.
Yeah. My husband and I have had great success in creating rhythms around that. But I agree with everything that you're saying. Totally on board. Well, Dave, thank you so much for joining us today. You have given us a lot of value. You have given us a lot of education and experiencing that per your principle on the website for what you do for investors. Thank you so much. And I just want to give you a parting shot. If you have anything left, you've given us so much, but is there anything left you'd like to say to the listeners? We can all find Dave's information, website, all the tools that he mentioned will be in the show notes today, but anything at the end, Dave?
Oh man, I got so much more. I think we should do a round two here. I'll maybe just kind of summarize that. I think that at the end of the day, because I've thought a lot about like life and, how I really want to live with purpose and all these things, lifestyle design. At the end of the day, when we look back at our lives, I think there's really just three things that matter the most. And that is relationships, experiences, and memories. And so experiences, relationships, and memories. I think that if we focus on those, along the way in business and with our family, people that we care about, we're going to live a life with purpose and fulfillment and really feel like we did it right, and be able to live with no regrets. And so I just want to share that because I think that, if we can incorporate that into how we run our real estate business or our families or even just, our social life, I think those are really the things that matter the most. So I'll finish up with that.
That's a great punctuation. Thank you so much for being with us today.
Thanks for having me. Appreciate it.
Thank you so much for joining us today on the Daily Real Estate Syndication Show. Don't forget to like and subscribe and tell your friends about what we're doing. Hope this content was useful for you, and I hope you have a blessed day.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.